I'm Ann Petrick, Vice President of Research for Vistage, and I'm happy to host the latest webinar in our Peak Performer webinar series, designed to support your leadership climb by bringing the most trusted experts to the Vistage community, those experts who provide exceptional insight and best practices to help you navigate new challenges and possibilities. Each year in our Q4 Vistage CEO Confidence Index survey, we capture the top decisions, investments, challenges, opportunities that from our members to understand what is top of mind for CEOs coming into the new year. In our analysis, we distilled data from nearly 1,400 CEOs into 4 key themes. Today, Vistage Chief Research Officer Joe Galvin is here to share those themes and offer guidance for how to navigate them. Joe is a respected thought leader who has presented and published all over the world for Vistage and has also been Chief Research Officer for CSO Insights and an analyst for Series Decisions and Gartner. Please join me in welcoming Joe Galvin. Joe, over to you.
Thank you, Ann, and thank you to everyone for spending a few minutes with us today as we share the results of our annual CEO Confidence Index that we do each quarter. But we really look at it coming into the year, and for 2024, we go through a process of evaluating them. Anyway, I'm just really excited to share this with you. I invite you to connect with me on LinkedIn, follow me on Twitter, along with Ann. We create content and post content just about every day that's directly tied to what our members, CEOs, are thinking about. And that's what sets up today's presentation, which is projections. It's our look forward into 2024 and what that might mean. And to start, it's kind of an unusual place because it's almost like this analogy of my hair's on fire and I'm sitting on a block of ice. On average, I'm okay. And that kind of captures the sentiment of our CEO community because for some, things have been going well and continue to go well and are managing challenges of growth, while others are seeing a slowing in their markets. Some are even in what might be considered recessionary. And it begs this question of, where are we going? All right, sorry, here we go. It begs this question of where are we? We've been through some pretty volatile times over the last couple of years, going through the pandemic and the economy that rolled out of it. So you beg the question of where are we? So we asked this question in our Q4 survey. Which statement best expresses your view of the U.S. economy? How would you answer that? Well, 50% thought a soft landing had occurred or was going to occur. 46% thought we were in a recession or going towards a recession. So clearly there's a fair amount of concern and there's no real consensus on where we are and where we're going, right? Is it any wonder that CEOs are grouchy, right? Inflation is trending down. We've seen the data that says that's coming under control. Yet prices are still 15% above where they were, and we're still seeing price increases that are both being inflicted upon us and that we now in turn have to pass on. Interest rates have peaked. The Fed came out and said, hey, we've got a good economy's going. But they didn't say they were going to lower interest rates. And interest rates are at 30-year highs, which are beginning to pull and slow the economy as anticipated. The impact to CEOs is it's difficult to access cash, or it's more expensive to make investments to grow. And the workforce velocity has slowed down. We introduced our concept of workforce velocity, which is the speed and the quantity or volume of movement as workers leave one company and go to another. This was in a frenzy state in 2021 as we were recovering immediately from the pandemic. But that's slowed now. But unemployment's still at 3%, 3.7%, which means there still are more jobs than there are workers. To understand what's going on, we turn to our confidence index. 4 times a year, we survey all of our CEOs. And our Q4 confidence, and it's important because it's an accurate predictor 9 to 12 months out of where the industrial economy is going, and that kind of pulls our community along. So we turn to the CEO Confidence Index, gives some insight about where we are and where we might be going. And what you can see here, which I think is really interesting, is we've reached this level of stability with a slowly rising trend. Over the last 6 quarters, we've been able to rise about 10 points at 82.0. And this slowly rising trend, again, if we project forward, suggests that we might see some positive things happening in the end of 24, maybe into 25. It's only when you take it in context of the confidence index, just going back to Q4 2010. This is the 21st year we've been doing this. We've got tons and tons of data from our CEO community, but I think about the 2010s from Q4 2010 to Q4 2019 as I refer to that as the rising tide decade because everything kind of went along kind of well. Our confidence index kind of moved with that. But when you look at where we are today at 82, we're still below any number that we've achieved, any low prior since the Great Recession. So it's rising, but it still is historically low. And if we break that down a little bit, and this is important to understand where we are, because this is based upon what our CEO community is saying. We had 1,363 CEOs answer these questions. Our confidence index is made up of three segments with two components each. If we talk about economic sentiment, you can see that 20% think the economy recently improved, um, up a little bit from Q3. Same thing when we talk about the economy to improve next year. 21% thinks the economy will improve next year. But what's interesting to me is that if we look back on confidence index from Q4 2022, looking into 23, especially here at the bottom, 10%, only 10% at this time last year thought the economy was going to improve. And we've seen some crazy big GDP numbers for Q3 and for Q4 that kind of fly in the face of that. So it's curious because this is sentiment. This is what our community thinks about the economy. When we move to revenues and profits, this is a little bit more data-driven, a little more fact-driven. And we see again that we're up 59% expect increased revenues, up a little bit from Q3, 47% increased profits, up a little bit, and both up barely and a little bit over a year ago. So you're seeing this profile of what we thought a year ago and what we thought today. It's pretty stable. This is what I look at most closely because it's interesting to see when CEOs are confident in their business, when they anticipate growth and they see opportunity, they invest, right? You have to invest. So we see that 35% are going to increase investments. That's the same as it was in Q3. 56% are going to expand their workforce. We look back to a year ago. The workforce is the only data point that's down a little bit, but it's still very strong. And when you compare the Q4 numbers from 23 to the rising tide decade and the norms, hiring is very, very close to what that norm is. Investments are a little bit off. But it sets the stage for understanding where we are. This is where we are. This is where we are. And that then begs the question of, well, where are we going? And for this, I turn to our friends at ITR Economics. We've been partners with ITR Economics for a long time. They presented all of our Vistage executive summits that we have around the country. And Brian Bolio had a chance to sit down with him in the middle of January to get their thoughts on where the economy is and where it's going. This is a members-only piece of content. I'm gonna reference a lot of content, and you can all find it on the Vistage Research Center. This is for members only, but it's really powerful. I just wanted to share one chart that shows there are summaries that the economy is basically going to be flat. I believe Brian used the word, it's going to be an off year for some. Some will continue to see growth as they've seen. Others will see slowing or maybe a little dip, but it's going to be an off year for some. But more importantly, comments on a sustained recovery into 2025, which means as we move through the next year of normal, we'll then see the start of that growth cycle into 2025 and beyond, as I interpret sustained recovery. And so it really kind of sets a stage that says, this is where we are. And with that, I'd like to welcome you to normal. This is normal. We've now have settled into, following the turmoil, the pandemic, and everything that followed on that, we've now settled into normal. And you might be surprised to know there actually is a town called Normal. It's Normal, Illinois. It's halfway between Chicago and St. Louis in central Illinois, home to Illinois State University, and just this wonderful Midwestern college town. But as a part to where is normal, I think probably more importantly is, what is now normal? What is now normal in this environment where our data suggests we're going to see a horizontal flat, slightly down, off 2024, growth cycle coming in 25 and beyond. So what is now normal? So to understand what normal is, we turn to our community. And again, the CEO Confidence Index. And I thank all of our CEOs that participate. I invite those that haven't participated to please do so, because it really becomes the voice of CEOs. And that's what we're listening for, is what is it our community, representative CEOs of small and mid-sized businesses across the country, what is it you're talking about? And what's on your mind? And so that we ask a series of questions that we've asked over the years, because it always gives us a sense of direction. These are open-ended questions. So for example, we always ask, what are the top decisions you're facing in the year ahead? So I'd ask you to pause and think for a minute. You know, what are the top decisions that you're facing, and what does that really mean in light of where your business is, and more importantly, where you want it to go? Because usually top decisions, that leads to what those key investments are going to be. And as we've seen over the last 3 or 4 years, top decisions have always revolved around talent, and investments have followed. Traditionally, we see technology as top investment, but we've seen years where when the hiring craze of hiring coming on. But decisions tend to lead to investments. We also ask about challenges because obviously we live in a challenging world and there's things we have to overcome, but it's always insightful to hear from our CEOs what they view as challenges, as it is understanding what they see are their greatest opportunities. We ask open-ended questions that we get anywhere from a single word to a long and elaborate paragraph. Our community of CEOs, I think, is an accurate representation and cross-section of American business leaders. And it really is unique with our confidence index because not only do we get, in this case, 1,363 CEOs to respond, that's a large number in the world of research, but it's pure because we know it's all CEOs. Because they're our members and they're participating and sharing their thoughts and insights. And that's why it was really interesting as we move into this concept of normal, what that looks like. And as we analyzed and took all these open-ended comments and put them all together and really spent a lot of time chewing on it, we realized that those issues all focus around business optimization. And it connected directly to the categories that we have in the Vistage decision model. We created the decision model as a way to focus on the decisions that CEOs make, how they show up as a leader at the core, how they lead, the processes of leadership. But this outer area of business optimization is where we see the focus and energy on as we look forward into, as we project ourselves into 2024. And so we're going to go through each one of these and touch on what some of the key themes are and then what the headline is. So let's start with talent. Talent has, for the last, the 7 years we've been doing this, has always been the top decision about increasing headcount, what to do with people, et cetera. The talent management issues have always been at the top of the list for decisions. The last couple of years, it has been the top investment because of hiring people and bringing folks in. And we still see the issues, still on the list is hiring and retention. We've seen hiring numbers at 56% are increasing headcount, and retention becomes important. Especially as everyone felt the pain of losing valuable workers during the craziness of the last couple of years. So there's been a shift to really focus on retention, and those remain as both investments in terms of what people are doing to retain their folks, challenges, and where their decisions are about hiring, right? Underneath that is workforce development, and this has been a theme that we've consistently seen come to us. Workforce development in terms of making investments in people. By investing in your workforce and training them, skilling them up on the job they have, maybe cross-training them on another job, or preparing them on whatever their trajectory is in the company, developing the workers. But equally, if not more important, is developing leaders and managers. If we think about the new workspace that we're in, the hybrid environment for many of the folks that do not have to be there, non-essential folks, no one's job has changed more than the manager, the boss, of people who work remotely or people who work in a hybrid environment. So learning how or investing in developing those leaders becomes a really important part of this whole story. And interestingly enough, coming up now for the first time really is succession planning. And it really takes on a variety, and you'll see how this kind of connects tangentially to some other dots we're going to talk about. But succession planning is how do I move people up and through my organization, which again is tied to leadership development, but also maybe to pass on to the next generation or to exit the business or to bring in new people. It's an interesting topic and one we'll be doing more work on. But when we think about talent and we digest all this, I think that the current headline is that we've entered into a talent truce, if you will. Given the talent wars that raged so crazy and the ferocity with which people left and joined and quits and all that, we've really settled into a talent truce. And I think that's important as we're in a normal environment, you wouldn't have that. But if we look at hiring, it's at 56%. You can see over the last 4 quarters, it's been pretty much in that range. And this is very consistent with the 10-year norm of the rising tide decade. We see retention stabilize too. Which means fewer people are leaving, more people are staying. We saw a real spike on this in 2021 when folks were leaving, but we've seen retention and attention to retention, which was a theme of one of our reports. We've seen that stabilize. So we see this settling in, if you will. This is the quit charts, and this was just published for December. And we can see in December there were 3.4 million quits. Now, that's the first time that number, and quits are people that leave your company to go somewhere else. This is workforce velocity. This is the movement of workers. And you can see how it spiked as we came out of the pandemic. But we're still right at the level we were before when it was pretty intense, but well off of where we were in 2009. And, it's pretty easy to understand. If you lost your job in 2009, there weren't more jobs. We're at a place right now of 3.7 unemployment. There remains more jobs than there are workers. And we're looking ahead to a growth cycle, which means that this number is probably going to turn around. But it's an important data point because what hasn't changed, there we go. What hasn't changed, or I'm sorry, what has also changed is the workplace status quo. We've now established what the status quo is for the workplace. And we've seen the workplace evolve over time as we've gone from desks to workplaces to cube forms of the modern office. But now we have a hybrid environment. And that hybrid environment has stabilized. In fact, we have reset the status quo. And one of the things about a status quo is the longer it's in place, the more solid it becomes. And so as those organizations and those roles in these organizations who can work from home, either fully remote or in a hybrid environment, those rules have been set. That status quo has been set. And we see in some of the headlines, the big company headlines, finance wants people back, tech people wants them back. They're telling people you have to come back. And I think in this period of stability, this normal era, this new normal that we're in, breaking that status quo is going to disrupt the worker balance. By that, I mean, there's a lot of conversation about CEOs wanting to bring people back to the office. And again, it's mostly big companies where you hear this, but, forcing people to come back. And I think what that does is it breaks the status quo. And now the worker is going to decide whether or not they're going to accept and say, okay, I'm back. It was good while it lasted. Or whether they're going to say, no, I prefer this hybrid or this remote lifestyle. And I'll go find a job that will allow me to balance what I want to do with my career and how I want to work. And that's not going to change. That is not going to go back. The hybrid environment is here and it will become a competitive differentiator. There will be some folks who, rightly so, are in the office all the time because they are ambitious and they want to be connected, et cetera. And there's others who will work from home. It's understanding that balance and the disruption to your workforce should you change that. Because the other consideration is that, and what hasn't changed is that workers have absolute transparency. If you go back to 2010, this didn't exist at the same level. Application. Every worker can find every job everywhere. And they can go behind the doors via glass door to see what people are doing. And even if you're not looking for a job, jobs might be looking for you because everybody's on LinkedIn, right? So this absolute transparency of workers to available jobs and available jobs to workers still is in place. And that is what is driving this workforce velocity, the speed and the ease with which people can change jobs. So should a CEO choose to break the truce and change that days in office dynamic, do that at the risk of losing people because they can still find jobs and there are still jobs to find. And oh, by the way, as we move into the rising growth cycle, right? And we see this today, this is from the Wall Street Journal today, we just saw 353,000 jobs were added. You can see the trajectory from the craziness of 22 and 23. These are very strong numbers. As the economy accelerates, as we move into the back half of 24 and into 25 and 6, the demand for talent will explode once again, which is why the attention to retention, the focus on your people, driving engagement is so important because humans remain the fossil fuel of growth. And as the growth cycle kicks in, the demand for humans will kick in. So the recommendation here is one, ensure you're doing the right things to retain and develop your folks. Think carefully about how you might change or alter the status quo and be prepared that you're going to have to hire into and want to hire into the growth cycle. That's headlines on talent. Let's go to financials and talk about that for a minute. The next element in our business optimization categories is finance. We spoke about the economy. We touched on that. And again, my recommendation is, invest the time to spend with Brian Bolio and the folks from ITR. They do a lot of talking about where we are, where we're going. They've also have talked about the 2030s and the Great Depression of the 2030s. They've got an excellent knowledge center on their website as to what's going on, the drivers for that. We're already starting to see the signs, especially in China. You don't see the birth rates, you don't see the economic growth. It's all driven by demographics. It's driven by debt. It's driven by budget. I mean, all the things, none of that has changed. In fact, Brian confirmed that's not going to change. So we've talked a lot about the economy. Um, Access to capital, that remains a challenge. Now, this is one of the lessons that folks learned during the pandemic about having a line of credit, securing a line of credit. Access to capital is critical, especially if you want to invest to grow the business. And this is where it came interesting because bubbling up was, and again, this was captured in decisions, in investments, in opportunities, was folks looking to acquire, sell, or exit the business and what their timing looked like on that. And it creates the headline of valuation. Have you established a valuation for your business? Do you know what it's actually worth? And we're going to touch on that because we asked this question in Q3 of last year, which was, which of the following are you planning for your business? And we found 20% said they were looking for an exit, 23 is sale, and 27 acquisition. And when you put that together, that means about half of our community are looking to do some type of transaction or transition. And that's really important when you now lay that out against what we know to be the timeline of the economy. You know, with stability provides for clarity. And we can now see a relatively flat 24 and then a rising economy through 29. And that's why this is important because of acquisitions, the dark blue and the gold are within 7 years, within the decade. And that becomes really important to think about. Because if you're planning a sale, you're planning to acquire, you're looking to exit in that time frame, there are a lot of dynamics that come into play. And I think one of the elements that we found that we see more and more people engaging is this concept of establishing a valuation for your business. I was with a group in December and was chatting with one of the members who had no intention of selling or do anything, and he was speaking to a mentor of his in the fall, and he says, "Hey, maybe you should take some money off the table." So he started to look into it. He started from scratch, trying to figure out all the things he had to do, just as an exercise in learning. Well, lo and behold, he had 2 offers by January. Whether or not he takes them is a separate story. It was the path of learning he went on to see what a transaction would look like for him. And that's something that we're going to see a lot of folks are in, a lot of folks will be moving into, and that's why it's important to have an understanding of that. We're still several months off on this, but we're developing a resource center on transactions to help accelerate the learning and direct folks as this time frame of opportunity between now and the end of the decade creates a chance for folks to move up and move on and maybe make a move on their business. And I think that's pretty important. Let's talk now. Let's turn to operations and spend some time on that because this is a really important category. Operations are unique to every business. If you're in manufacturing, if you're in construction, if you're in professional services, you're in healthcare, you're in technology, whatever it is, there's a lot of unique attributes to that. What's common to all is technology, and that's the area that we tend to focus on in operations. Technology has historically been the #1 area of investment, of course. It's driven a lot of the decisions. It has a lot to do with growth. And there's no doubt that technology was the saving factor from the pandemic. If we had not had the level of technology in terms of laptops and mobility, broadband access, ubiquitous access everywhere in collaboration apps, if the pandemic had hit in 2005 or 2010, we would have been crushed. But because of how far we'd advanced, it actually saved us. And if you look back over the career, you know, technology is a change agent of our generation. So it's a really important part and piece to all. And it always shows up in our investments. It always shows up in challenges. And it's interesting because, you know, what is technology? It's about automation. And automation is more than just putting robots on a factory. That's a big part of it. But automation also has to do with business applications. And how does your organization use collaboratively a business application for finance, for HR? Maybe it's a CRM app to manage customers, and how are they integrated? Automation is much more than just technology. It is having the humans that can leverage and capitalize on that technology to improve the performance, the productivity, and all the good metrics of the company. So we see an emphasis on automation. And again, our recommendation here is before you go buy new stuff, make sure you're getting the most out of the stuff that you have, because it's your technology platform that will drive your transformation. Artificial intelligence was the big story. It was the big headline in technology last year. It was this time last year that ChatGPT was all of a sudden getting a lot of attention. All of a sudden, we had access to an AI tool that we all could use. And it dominated the headlines and it dominated a lot of thinking. And then it kind of passed a little bit, and there's not as much energy behind it as there was a year ago. but it doesn't mean it's not critically important. We're going to spend a few minutes on that here in just a second. Cybersecurity. Cybersecurity remains a big deal. And we're going to touch on that too, just for a second. But let's talk about artificial intelligence if we could. Because all this leads into the headline here, which is accelerating digital transformation. As we said, I just said before, those that were further down the path of digital transformation had done better, did better, were more nimble during the pandemic. And that remains to be true. Digital transformation is the movement from analog systems and processes to digitized process and workflow. It's using a human resources app to manage your people and the humans in your organization, as well as to drive your recruiting, your customer relations systems, your financial systems, your factory automation systems, whatever those systems are. It's all about advancing your digital transformation to capitalize more on where technology is going. And clearly a big part of that is going to be artificial intelligence. And we heard a lot of folks, especially early on, talking about the hiring crisis, say, oh, AI to the rescue. I won't need to worry about the workforce shortage or the pending workforce shortage because I'll have AI in place and that'll make it happen. And the answer is AI is not ready to do that. It'll be a long time before it does that. And just as rapid change, and we've talked about accelerated disruption, as rapid change occurs, we adapt and adjust to it. So the thinking on AI from our perspective has got two threads to it. Thread one is that AI will power individual productivity and performance long before we'll be able to figure it out as an organization. By this, I mean it's individuals and how individuals will be able to leverage and capitalize on the individual AI tools depending upon what they do. If you think back to the late 80s and 90s when all of a sudden Excel and Word and PowerPoint, these new technologies, these new applications came on the scene. Some individuals quickly grasped the power and the potential of those tools and jumped into them and learned how to use them. And that was a competitive advantage. And then eventually everybody kept up. And now it's like, everybody knows how to use that stuff. Well, AI fits in the same way. I saw a data point that said 85% of workers are using AI, but are afraid to tell their boss. Look, AI is here and its ability to access and spin data, spin information is much better than what we can do. And that's why I think the approach to this is to, one, recognize that you can power individuals first and power them up and get a boost in performance and productivity now while you address the longer term needs of organizational digital transformation, which is a big lift. The key is to identify the appropriate applications, AI applications that your folks should be using. Chances are they're on them. So let's go out and find what applications people are using. Let's standardize on those, right? Let's understand what those are and how they're used, because how someone in one department versus someone in another department might use them are different with different tools. You already have expertise in your organization. The key is to identify it, harvest it, and then share it. There's a blizzard of applications that you can get for whatever the function is that you're looking to automate. And again, I would suggest to you that many of your workers are already doing this. The key is to identify what those applications are and then standardize on them. Then train your workforce extensively on this. Those people in that work group, train them on how to use these applications. And that will quickly unleash the personal productivity of these tools. It's also important to recognize there's a security issue with AI. Because if you just go into the public chat GPT and you start entering data, that data is now in that learning model forever, which is why having a security layer around this is really important as well. But the key point here is identify what people are doing, identify how they're doing it, and then train other people on it so everybody gets this advantage. And then accelerate the organizational transformation. And then that means go out and go look in your organization and see how far you are down the path of digital transformation and what you need to do that. Now, to get some expertise on this, we turn to our friend, Mark Emmer. Mark Emmer is a Vistage member. He's a Vistage speaker. Each year, Mark does his business trend series that he does as part of his business, and we are just so happy and fortunate that he shares this with us. And this was done, we did this in early January. Again, this is available in the Research Center. But Mark talked about organizational transformation. And he shared this chart that shows how you move up the hierarchy. I call it the stairway to digital heaven for artificial intelligence. Now, there's also another continuum to consider on this, and that is the big company, small company, right? As for our smaller companies who do not have the resources, do not have the expertise, and can't afford them, it's a different strategy, it's a different approach than as you become larger and larger and you start to have these resources and assets. Whether you're big or small, it doesn't matter. You have to find the path forward when it comes to AI and digital transformation. The key for smaller organizations will be to lay into or lean into applications that already have AI in it. And if you haven't been pounded by your technology vendors about the AI capabilities they have, then maybe you're working with the wrong vendors. But for smaller organizations, that pathway to organizational AI is going to be driven dominantly by the capabilities that exist in your applications. As you get larger and you have more data, you can do more things with it. But it really creates an interesting scenario because as we move through the balance of the decade and we see the growth cycle for the second half, it will be the degree to which we have advanced and accelerated our digital transformation and our digital strategy as we seek to ride out the 2030 Great Depression. It will be a key component to all. It will be a buffer to all. And clearly, it's a place of investment. It's a place of challenge. It's a place of opportunity. And that's why it's so important that we have the focus on digital transformation. Again, I invite you to tune in on the business trends. Mark did a great job, and it was a lot of fun working with him on it. But before we leave technology, we got to talk to one more topic here. I'm sorry, I'm not to include this. This is new. How are we approaching it? So we asked this question: what describes your business's approach to open or generative AI? What are you doing? So I ask you this question: how are you approaching AI at this point in time? Well, what we find is just in cross-section that hasn't really changed that much over the last year. The yellow says 17% are currently using as part of daily operations. So some people have crossed that gap and are engaged. Another 35% are testing it for select functions. So you're seeing about 50% of the folks are actively engaged. 18% say, no, we're planning to test. 24 have employees independently, and then another 23% don't know or not using it. So we're taking a cautious approach, but we are approaching it. And that's what's important is AI is not going to be the life preserver. It's not going to change all things. And yet it continues to come. It's been the hype for 10 years. It'll be another 10 years. Having said that, the time is now to begin to engage with this. Most importantly, not because it's AI, but because of what it can do for you, how it can drive the productivity of your organization, and how it will become a competitive differentiator and a business survival tool as we move through into the 2030s. One more point, we developed an AI resource center, and Petrick does every so often she does a session with members or with experts talking about what are people actually doing with AI. We've built an AI resource center where we put in content that we create, content that we curate. I invite you again, it's all in the research center. You can go find it right there. One last point, and that's cyber. It's not a topic people like to talk about, but it's real. We asked this question, have been asking this question for a number of years. Does your company have a defined cyber strategy? It's documented and communicated. So let's pause. Do you have a cyber strategy in place that's up to date, current, and monitored? And I say that because a cyber attack can take your business down as sudden as a heart attack. We found that 58% said, yes, our strategy is current, reviewed annually. It's this other 15% that's not current and doesn't have a renew cycle. As fast as technology is going, as fast as we were just talking about AI, your hackers, they live in that world. So they're going faster than fast, which is why being out of date is the same as not having a strategy. 10% say no, but they're working on it. Well, that's good news. And 16% just says flat no. It's important to see how far we've come over the years as we've asked this question, and I've kind of hyped the cyber boogeyman. But it's really important to understand that a cyber attack can take your business down very, very quickly. 4% of our community experienced a cyber attack that cost them data and or money. And I'm sure you've heard, or we could spend the rest of the day exchanging stories of different people who got beat. And it's always one of those things that until it happens to you, it's not real. Well, this is only going to continue to be worse. It's only going to require more time, diligence, and money. And just think of this as your technology tax. Because again, and I'll stop railing on cyber. Cyber is the single greatest threat to your business right now. And even if you have a strategy that's current, it's still a risk because they will find a way to get through it. If they can hack into energy systems, some of the stuff that governments are doing, they can get into your stuff. So I would also point on cyber personal protection, that you're doing the right thing about passwords, et cetera, et cetera. So that's technology. Let's talk about customers, because customers is one of my favorite topics. We've done a lot of work with customers over the years. We've done a lot talking with customers about how to manage customers. We've done pieces on marketing and on sales. And in every economy, the right answer is always get closer to your customers. Economy's bad, economy's good, market's bad. The right answer is to always get closer to your customers, because your customers are experiencing the same normal that you're experiencing. But most importantly, it's your customers that will tell you when things will change. It's your ability to understand and monitor your customers' buying behaviors and the subtle shifts that will give you insight to say, okay, things are starting to move this way or that way. We have seen and heard stories of slowdowns, delays, outright cancellations. When you start to see that turn, or your sales cycles begin to accelerate a little bit, or order sizes tend to grow, that's how you'll know that we've crossed this gap to growth, and that the growth cycle has kicked in, right? For some, that means managing demand. And we had more than one comment and more than one member comment about how they're struggling to keep up with demand. They can't manage inventory, although the supply chain issues have passed. Remember those fondly. It's still a challenge to keep up with demand. And it has to do with people and facilities and space, and good for them. Others have the exact opposite. The demand has slowed, demand is delayed, and they're struggling with those challenges of not just trying to support what they have, but to try to grow and try to maintain as much ground as they can. So again, when you talk about opportunities, you talk about challenges, a lot of it has to do with managing demand. New products and markets. When we talk about growth, we talk about opportunity, we talk about investments. A lot of folks are thinking about new products and new markets. You know, I mentioned earlier, or just before, that your customers are experiencing the same normal that we're experiencing. Well, the same is true for your competitors too. So this is a great time, because maybe your competitors might have struggled more. Maybe they're seeing more challenges than what you are. Maybe they've overpriced, right? But it's a great time to go and look at the competitive accounts that you've always wanted to get into, and just, you know, knock on that door or pick up that phone, see if there's opportunity there. It's a chance to introduce new products. Growth comes by acquiring new customers, which in many markets means acquiring a competitor's customer. But it's also with new products, new services, new capabilities. And again, these are decisions, these are investments, and these are opportunities that we see out in the marketplace that our members are gravitating to. And there's always this concept of marketing and sales discipline. It's clear the relationship between sales and marketing alignment needs to continue to be tightly aligned. It needs to work better and better. You know, there's the shift between when your customers engage digitally and when they want to engage physically with sales is still in place. And there's no question that there is a real gap between what CEOs expect of sales forces and what they've been delivering. And so again, part of normal, it's always about ensuring that marketing is continuing to provide and promote. Marketing has two functions. It creates leads and opportunities, and alleviates post-purchase dissonance. And having sales and marketing aligned are really important. Again, this is normal. This is part of normal. It's just applying that in this new normal. But our headline here, and this is an immediate thing to think about, is right pricing strategy. Folks are doing right sizing. Well, we need to do some right pricing. And I say that because we have all but become immune to prices being raised on us. This is the fuel of inflation, and we've in turn passed on pricing. Good, bad, or clumsily, we've done that. Well, as we move through this period of normal, as we enter into this 2024 of an off year, flat year, slow year, knowing there's a rise ahead, it's time to pause one more time and take a strategic view and think deep about your pricing strategy. Are you priced correctly for this new normal? Are you positioned from a pricing standpoint for the growth cycle ahead? Have you overpriced? Have you underpriced? How are your customers receptive to price? There's an opportunity here, and we can always raise prices when when inflation's going, right? But now that we're stable, and with stability comes clarity, now that we're stable, there's one more shot at right pricing and going through a strategy to make sure you have your prices right. Growth is going to come from new markets. Growth is going to come from, you know, more business from existing companies, and growth will come from pricing. We see, and we touched this earlier, but we see that 59% of our community thinks sales revenues are going to grow in the next year. 29 is going to decrease. So we see growth from revenue rising. For 54% of folks who will be increasing prices in the year ahead, that's going to be part of it. So if you're not considering or you're thinking about staying the same, I think there's one more window here to think about making sure you're priced correctly, making sure that you're priced in a position that meets your needs, but also anticipation of the pricing that may come to you, right? Part of your pricing strategy is how you will approach the prices that are passed on to you from your suppliers. We know there's pressure on workforce. We know that wages continue to be a pressure, and that's obviously part of your pricing, but the supplies that you need, whether it's people, equipment, whatever, this is an opportunity to take a look at that. And I think it's really important because once we move through the prices set the status quo, they get locked in. Well, to only we're a good friend, Casey Brown. On December 8th, we had our business growth conference, CEO conference, and Ian hosted it, and we had some really good folks on board with it. And Casey Brown came in and talked about pricing, and her whole thing, she's self about pricing geek. She came in and talked about how do you understand the concepts and methods, opportunities, having the courage to act, having the right strategy in place, because you can get 3 or 4% growth if you price effectively. You could also upset a lot of customers and create opportunity for your competitors if you overprice. So the headline here under this category is price it right. Go through one more exercise, one more experience of getting your pricing right, so you can be sure that that you're positioned correctly for 24 and then into the growth cycle. And that's what we learned as we put together the thoughts and the comments and the insights of our CEO community, and we looked at the economic data on building this bridge to growth, bridging the gap to growth. How are we going to get there, and what that's going to be? And we found, again, the main themes that come through under talent is the talent truce. It's a concept that we've established the status quo, and that any change to that is going to make people rethink whether or not it's the right place for them. And the absolute transparency to both jobs, people to jobs and jobs to people means that we can very quickly, this truce can be broken, especially in the workplace. And we'll be back where we were a couple of years ago. As the growth cycle kicks in, that will continue. That will create a pulling function anyway. So that's why the talent truce is important to understand now. This concept of valuation validation, understanding and knowing what your business is worth today, whether you're thinking about selling or acquiring or doing whatever, it's an important metric to create an objective and defendable valuation for your business and use that as a proxy for growth. I mean, we can talk about growth of revenue, growth of EBITDA, growth of profitability, but what is your business actually worth? It's kind of crazy. We saw, a sports franchise, a legendary sports franchise just got sold, and its valuation was well above what the owner thought it was. Well, do you have a valuation that's right for your company? Most owners have a valuation beyond what it really is, and it has to be more than just X times EBITDA or X times revenue. There has to be a methodology that is defendable. And that's why this concept of a valuation validation is one that we think people should be thinking about as it connects to this broader bridging the gap to growth and how you get there. Digital transformation and technology, AI, automation, cyber, technology is the key to everything that we do. It is a driving force behind productivity. We've seen our GDP grow dramatically over 50 years. We haven't seen our workforce grow at the equivalent level. Why? Because technology's come into play to make that happen. And then right pricing, getting your pricing strategy right, price it right. And the time to do that is now. And that's all really important because these themes that came out of the comments that come from our CEOs really helps to identify how we bridge the gap to growth. How do we get through this 24 soft year and get to that rising tide of 25 and beyond? And that's important because you sit back and you take the long view, and we can see that we're in this normal economy in 2024 that is both the CEO Confidence Index data supports and commentary from our friends at ITR, Brian Bolio and that team, that it's going to be a normal, an off year, and then we're going to see that growth cycle. That growth cycle is going to balance the decade. And there won't be a moment where the curtain opens and 2030 happens, but it will happen. And it will happen at one level or another. And it's easy to sit here and project forward and say, doom and gloom. But the demographics, cost of healthcare, rising debt, all these factors are already in play. We've already seen the shift between India and China. It will be coming in. And what that means is that we know that that's a bracket, but if we look ahead, it says we have an opportunity here to get through 24 and be positioned to get on that wave and to ride that growth going forward. And that's where we think that bridging the gap to growth, the key to that is about planning, right? This is a great opportunity to plan. With stability comes clarity, and we can see pretty clear ahead. Now, it's not to say that geopolitical tensions, be that Taiwan, be that in the Ukraine, be that now, once again around the Gulf, another path. There's nothing to say a black swan can't happen, but we have now absorbed the last vestiges of the aftermath economy, and we're now in this normal period as we prepare to grow, which is why the key to bridging this gap to the growth cycle is to plan. Now, I'm highly confident if you've been a Vistage member for more than 30 seconds, you've been through some exercise of strategic planning. And it's not so much that we're failing to plan, but it would be unforgivable to fail at planning. To fail at planning, to go through the exercise and just not do it right. And that was the genesis behind a report that we published in November called Identifying the Gaps in Your Game. It's strategic planning. We asked our community, and this was in the Q3 confidence index, and 72% of our community use an internally developed approach, an internally developed process for strategic planning, which is great because we know that we know everybody's doing this. Now, it's not like no one's not planning. It's using an internal process. And I found that was interesting. So this is what our CEO community said. And so we leaned on a group of about 15 of our best speakers and chairs who are strategic planning experts. And we asked their opinions on a few things. And it was our good friend and master chair from Pittsburgh and Phoenix, Chuck Benares, who talked about two things that really jumped out that's in the report. One is that operational planning is not strategic planning. Your operational plan comes out of your strategic plan. Operational planning is critical, but it's not a strategic plan. A strategic plan, and this is why the simplicity and the purity of this is so important, begins with where you want to be in the future and then works backward to understand where you want to be. And again, in this period of this new normal and the stability with clarity, we can kind of see what's going to happen over the next 6 years, which is why bridging the gap to growth is all about planning. We went through the analysis, and again, our members, our respondents are so generous with their thoughts about all these different things. And we found that there were about 6 common components. Again, with 72% of CEOs following an internal process, you put it all in a big pot and you melt it up, and there's 6 components. I thought of them as deliverables that when you look at different plans, they all seem to have elements of this. And we asked our CEOs to rate themselves. And not surprisingly, we scored ourselves really high. You can see here across these 6 components that we came up with, strongly agree and agree. But it was really interesting because for this first question, my company has a well-articulated mission, vision, and purpose. It was really interesting that our members ranked themselves very high in this, because when we asked our community of experts, we got a very different response, where 59% of our CEOs strongly agreed, strongly agreed, and another 35% were neutral on the power of their mission, vision, purpose. Just a couple of our experts thought they were good. And when you go through all 6 of these deliverables, you can see that there is a gap between what our CEOs think about our planning and what the experts do. And what's powerful about the experts, and we've had many of these speakers in our groups, we went through the most popular speakers. What's powerful about this is an objective perspective from someone who works with hundreds and hundreds of strategic plans, who are able to see them across industries, across company size. People that really understand it at a very deep level are experts. For many people, it's their business. When they looked at how we perform, overrated was the right word. And that's why it's so important as we now look ahead and bridge the gap to growth, that you focus on your planning and you think hard about what you're good at and what you're not good at. And as we said in this report, what are the gaps that you can do to strengthen your planning? Because the key to capitalizing on this upcoming growth cycle is going to be planning. And in fact, it was Brian Bolio who said in our session with him, said, if you plan, you're going to be among those that outperform the economy. Now, we know that everyone in the Vistage community goes through a strategic planning process. My request to you is to take a hard look at how you do it. Most people have completed their strategic plan to go into 2024. Well, now's a good time to go back and do a debrief, do an autopsy. Our speaker of the year last year was an ex-Blue Angels pilot. Talked about the most important part of their mission was the debrief. Go through a debrief with your team on how you created this strategic plan. Not what it is, but how you got there. Identify whatever weaknesses or areas you could improve, and then double down, because the planning that you do in 24 will set you up to capitalize on this growth cycle. And once the growth cycle passes, we'll be in a very different place and we'll deal with those challenges at that time. But right now, bridging that gap to growth, it's all about planning. I'm Joe Galvin, your Chief Research Officer at Vistage Research. It's our job to share with you what we hear from our community about the issues, topics, and decisions that our community says is most important to them. So it's been a lot of fun sharing this data with you. There will be an executive summary on this coming out. This webinar is available to share. And again, I thank you so much for your time and attention. And with that, Ann, I'm going to come back to you and see if we've got questions or comments to talk about.
Excellent. Yeah, thank you, Joe. I loved the idea that we're in some sort of normal. We did have one question because it is a really good question. Where are we really? And you answered that at the beginning. But someone noted that the job report was the strongest in December and January when compared with last year. So do we, or does ITR still feel like we're headed into a slowdown or recession in 2024? And I know that you and Brian had that conversation a couple of Fridays ago where you talked about their prediction that they're still looking at a shallow recession in 2024. Can you elaborate a little bit more on that?
I haven't spoken with Brian since we spoke 3 weeks ago. I don't imagine it's changed his opinion. I think the was it 353,000 jobs that were added, well above what expectations were. I think that's an indicator going forward. I think it is, it's a reflection that there are some industries that are growing. And I think more importantly, it may cause the Fed to pause even longer on interest rates. Interest rates have peaked. They're at 5.5, 5.25. They haven't come down. The Fed said this week that we're in a very strong economy. It's a very healthy economy. So if anything, I think what that data point will do is, one, it may defer any rate cuts from the Fed, and that's not going to help business, but from the Fed standpoint, it'll help slow. But I think it also, comments to the talent truce point that we made, that we're still seeing 56%, 59% are adding headcount in the year ahead. The headlines, big company headlines, big tech or big finance or whoever, UPS is laying off people. I don't see that in the community of small and mid-sized businesses. So I think it's merely just another, maybe it's a green shoot. I don't know, it's February here. It's pretty warm. A couple green things are coming up, but I know it's going to get buried with snow because spring ain't here. But I think that's what it's indicative of.
Yeah, agree that one of the components from ITR is that they're looking at the yield curve, and the yield curve is still inverted. So that's one of their factors that they look at. I believe Jackie Green said in her conversation with you that they also expect 2 quarters of GDP decline, maybe not consecutive quarters, but 2 quarters of GDP decline in 2024. So that's also part of their equation and prediction for a mild recession.
Yeah, it's a stable year, and stability brings clarity. So we can see forward. No, that's anything could happen, but yeah, that's where they're at. And again, I invite folks. It's a member only, but I invite those members that haven't seen it, to spend that hour with Brian. It's well worth it.
Exactly. Talking about pricing, you mentioned Casey Brown as our expert. When I was in the Raleigh area for their executive summit last year, Connor Lokar from ITR said, be prepared for the pricing knife fight. He mentioned that supply chain has righted itself. And so those who were competing on the fact that they were able to turn things around or get some of the goods and inventory they needed, now it's going to be a little bit different. And we had a question from one of our attendees: how do you know you have the right pricing strategy? I know Casey Brown talked a lot about segmenting, that the pricing strategy is not one size fits all, that you want to really look at your customer segments and figure out where you have the opportunity to raise prices and what levels. Do you have any insights on that to add?
Well, I don't know that you can actually identify what the right pricing is, but you can be assured that whatever it was yesterday, it won't be the same today. Inflation is still, maybe it's at 2%, but it's still growing. It's right pricing is more about how customers react. How do prospects react? We've all gotten price increases. I just got one today for my local trash collection, right? And you get numb to it after a while, but we've reached a point, I think, where there's no longer defenses as to why you're raising prices. So that's why this concept of right pricing right now can set you up to be in a good position. Because if you fumble that, either in terms of getting the number right or in how you communication or prep your sales force for it, it can be difficult. So I think the answer to that is less about thinking it's the right price and observing the behaviors of your customer in your market based on how that pricing goes.
Right, as you said, getting close to your customers, understanding their needs so that you can react accordingly, understanding their challenges.
Yeah.
And certainly, all of the experts say, that you should not be competing on price alone, that really think about your competitive differentiators beyond price, what you do better than anyone else, and really focusing on that. So, some of our friends at ITR have said that, as well as Casey Brown. So, just as much as having the right pricing strategy, you talked about sales and marketing alignment, and I think it's really important to align your messaging to where customers are today, what are their pain points, and how you solve them as well.
Yeah, it's a great segment. Again, I highly recommend you invest. It's only a 30-minute segment, but it's really strong.
And one last point you mentioned at the beginning, where we are there, everyone's all over the place, team soft landing versus team recession. The other thing that I've noted is that many industries are at different places in the business cycle. And so what I've heard, construction, residential housing have actually been in the recession, are starting to come out. So just commentary on anything that we see by industry and what we know about that.
Well, I think what happens is that when you get into a period of stability, relative stability, you're better able to separate who's doing well and who's doing not and where they are. And there are some segments that have been struggling, and there's other segments that have been doing well. So it's a broad indicator of where things are going, but it's unique to all. And we all know the phrase all boats rise with the tide. Well, the tide's kind of a flat tide right now. So the boats that are rising are the ones where people are paddling the hardest or paddling the most efficiently versus folks that are just waiting for the tide. So I look at these and I say, this is all on a broad commentary basis. You can make the same comment about the jobs number. When you break down those jobs, many of those jobs are going into places that are still undermanned from the pandemic. And other places, they're shedding jobs, tech overhired. We know that. Finance, same thing. So it's all relative, and it's what's unique to you that matters to that. But I think, we saw the jobs number spike, this spike. I think that's where we're going to be going with this stuff.
All right. Well, thank you so much, Joe. Welcome to Normal.
Thank you. Thanks, everyone.
All right. Thanks for your time. We'll be sending a link to today's recording and slides within 24 hours. I also mentioned we're preparing an executive summary with some of the data and insights from this presentation, as well as our Q4 CEO Confidence Index report. So this was the final webinar in our series that was designed to help you gather insights to help you navigate today's climate. Heading into the new year, Mark Emmer had shared his insights on business trends for 2024 and beyond, as Joe mentioned. That's distilled from his popular series in the Vistage Research Center, and that webinar is available on demand. Joe mentioned the ITR, the member exclusive webinar that we held on January 19th, that's available for a limited time. So that's another piece of content that I highly recommend. And upcoming for our members, please don't miss our Vistage exclusive with Marcus Buckingham, based on his best-selling book, Love Plus Work. And that will be streaming on March 1st. You can register now. You'll be able to have access to the recording of that session with Marcus Buckingham through the end of May. But highly encourage our members to register for the streaming event on March 1st. Have the opportunity to comment with your fellow Vistage members from around the world. So all of that can be found on vistage.com/webinar. That's vistage.com/webinar. Thanks everyone for your time today. Be safe and be well.